U-turns on tariffs have rocked the market, but will they slow the US economy? The Trump administration has now suspended tariffs on most goods from Canada and Mexico for a month, only 2 days after it brought them in. The uncertainty has made the market very jittery. Overnight, the Nasdaq entered confirmed correction territory, 10% down since it peaked last December. Russ Mould is investment director at AJ Bell. Russ, the reversal of these tariffs doesn't seem to have given the market all that much relief then.
I wouldn't want to be running a business on this basis, which is in the end what executives and boardrooms are trying to do. What they want above all else is just to know what they're dealing with. Sure, I'm sure they won't like tariffs, but if they know they're there and they're going to stick, then at least they can work a way to deal with it and try and adjust their cost base, their supply chains, or their pricing. But if they're on 1 month and off the next month, it's really hard for them to know what to do. And I think that's why you're seeing share prices be volatile and the VIX index, for example, jump so much.
Well, concern about a trade war and price rises from those tariffs slowing down the wider US economy is growing. How worried should we be?
I think investors will be worried because they're already expecting great things from America. The stock market's done well. It's trading at historically a very high valuation. You've got corporate earnings growth expected to grow at between 14 and 15% this year and next year, well above the long-term trend. So from an investor's point of view, America is already great. It's already tremendous. It's going to be very hard for Trump to make things better. If he makes things worse or his policies backfire, that's when the challenges could be, because the one thing American equities are not priced for is a global slowdown or even a recession.
We have, as you say, already seen some slowdown from those record highs in US equities and a surprise recovery in Europe since the beginning of the year. Is it time to move money out of US stocks and perhaps take it elsewhere in the world?
It seems to be an insurance policy that some investors are using, in that the UK is doing is budging near all-time highs. We've seen Germany actually consistently hit new all-time highs. And I guess that's a valuation thing. Expectations for the UK, Germany are particularly low right now because their economies are struggling. But that could mean that valuations are more attractive because they're unloved, underappreciated, and therefore potentially undervalued. America, as we've just said, has got the opposite challenge. Expectations are really, really high, and if you don't meet them, well, there could be trouble or at least volatility ahead. So I can understand why some investors would be thinking along those lines.
We do, of course, get the crucial US jobs report out later. It's expected to come in fairly strong, but of course this is before the impact from trade policy has really kicked in. Do you think the US labour market may show some signs of worries?
Well, we've seen some noise there already with the ADP payrolls this week, which undershot expectations, and the Challenger Gray and Christmas job cut survey, which actually exceeded expectations. And that Challenger survey can lead weekly unemployment claims by a month or two. So that's definitely a trend that's worth watching. We're already seeing a lot of noise in the US economic data more broadly. The Atlanta Fed GDP Now surveys has collapsed to suggest a shrinkage in the first quarter. But a lot of this may be companies trying to second guess what tariffs might mean. And again, so I think we will get some very, very messy and noisy economic data for probably most of the first half of this year.
Where in the US economy are the biggest vulnerabilities, Russ, from these tariffs? Where should investors really stay away from?
I mean, the fact that Trump immediately listened to special bidding from the automotive industry was very, very telling, because they said quite clearly that there would be a very big jump in their cost base, and that would then filter straight through to consumers. You've seen consumer expectations of inflation rise quite sharply to around 5 or 6% on a 12-month view. That's it, consumer confidence. So you would worry that the consumer, at least at the start of this process, is in the firing line, and that's why I've seen retail stocks come under pressure, and some disappointing statements recently from Macy's, Target and Walmart.
That was Russ Mould of AJ Bell. Don't forget, you can watch more videos on Reuters.com.